In this video, we'll be going over IRS Form 1098, Mortgage Interest Statement. There are lots of different versions of Form 1098 out there, different informational returns. Usually they're marked with something like 1098T, 1098C, so on and so forth. And we do have a bunch of those articles on our website. But this Form 1098, without anything afterwards, specifically refers to your mortgage interest statement that you would receive from your mortgage company, your lending institution. So most taxpayers are aware that you may be able to deduct mortgage interest for tax purposes. So we'll talk a little bit about the situations in which you may be able to do that, and then we'll turn and face the form itself so you can better understand it and determine what you might report on your tax return. So the most common taxpayer deduction would be to deduct mortgage interest as an itemized deduction on Schedule A. So this is the most common type of mortgage deduction, and it's only available to taxpayers who itemize their tax deductions as opposed to taking the standard deduction. So if you take the standard deduction, then unless this is a rental property or some sort of mortgage that's related to a business that you own, this probably isn't going to do you a lot of good. So we do cover situations where you may consider taking or itemizing deductions as opposed to the standard deduction elsewhere, but that's not the focus of this video. So you can deduct interest paid during the tax year on Schedule A. If you are a business owner and somehow this is related to your business, then you could find a way to deduct it on Schedule C. If this is a rental property, then you may be able to deduct it on Schedule E. So, and then for farm related interest that you paid a mortgage on, you may be able to deduct that on Schedule F. So there is a table in IRS publication 936 which covers home mortgage interest, and we've replicated that table in our article. So depending on the use of the interest on this mortgage, for example, if you took out a home equity line to pay other debt down, like student loan debt or investment interest, then you may not be able to deduct that against your mortgage on Schedule A, but you may find other places to deduct that interest that was paid. So if you want to take a look at that chart, you can find it in IRS publication 936, or you can simply go to our article, and it's at the end of the form instructions in our article. So now we're going to go through this tax form so you can better understand it. You should know that there are 3 copies of it. The first copy always goes to the Internal Revenue Service. The second copy goes to the taxpayer. And then the third copy is retained by the financial institution or the lender. So on the left-hand side, you'll see the information for both yourself and the lender. So in this case, John Doe has a mortgage that he's paying interest on to Acme Lending Solutions. You see their full taxpayer ID number. His taxpayer ID number or his social security number is truncated. On the IRS version of this form, it won't be truncated. It'll contain the entire social security number or taxpayer ID number. So then the rest of the information should be the street address, that John Doe's residence. If while you're reviewing this is an incorrect street address, you may want to notify your financial institution, update your files, and then also check your IRS record to see if your address is correct. And if it's not, then you can update it simply by filing your tax return. You can also update it by filing IRS Form 8822 or IRS Form 8822-B, which is what business owners would use to change their business address. So there are a couple of other blocks down here. We'll get to them in numerical order. So now we're taking a look at the top right hand side, and we'll go through boxes 1 through 8. In box 1 is the mortgage interest that the lending institution received from you during the tax year. So this is the part that you would deduct on Schedule A if you're able to. And basically, this shows the amount of mortgage interest that they received. This would include any mortgage interest from a home equity loan, or a home equity line of credit, as long as it's secured by a piece of real estate. So real property, could be land, it could be the land that your motorhome sits on, it could be an entire home, a condo, as long as it's considered to be real estate. Now with motorhomes, it's a little tricky because the home itself usually is considered personal property, not necessarily real estate, while the land, if you own the land, that would be considered real estate. So this amount does not include any points, government subsidy payments, seller payments on a buy down mortgage, or anything like that. You may be able to deduct those, but those circumstances are a little bit more nuanced for this video. So if you prepaid interest in 2023, if you prepaid a little bit of 2024 interest and it was reported on your 2023 Form 1098, that prepaid interest might be included in box 1, but technically by the rules, you're not allowed to claim prepaid interest that was paid in advance. So in other words, if you paid 2024 interest in tax year 2023, then you do have to wait until 2024 to claim it, according to the form instructions. If you have a mortgage credit certificate and you can claim the mortgage interest credit, then you should look at completing IRS Form 8396. So we'll put a link to all the forms and schedules that we mentioned in this video. We've created articles and videos on those. We'll put links to those in the show notes. So one of the criteria for being able to claim interest on Schedule A, whether it's a mortgage, whether it's a home equity loan, or a line of credit, is that it has to be secured by a qualified residence, and you can only deduct the amount that was attributable to what's called acquisition indebtedness. Acquisition indebtedness is the amount of a mortgage that was used to either purchase, build, or substantially renovate a home, substantially improve a home. So let's imagine that John Doe takes out a $150,000 mortgage, as it says in box 2, but he used $50,000 to pay down a car loan. The other $100,000 went to secure his house. He would be able to deduct the interest that was attributable to the $100,000, but not the $50,000 that was used to pay off his car. So in box 2, this shows the outstanding principal on the mortgage as of January 1st of the calendar year. So if the mortgage originated in that year, then it would show the mortgage principal as of the date of origination. If the lender acquired the loan in the calendar year, then this would show the mortgage principal as of the date of acquisition. So as you can see here, box 3 indicates that they started the mortgage on June 6th, and this was what the balance, the mortgage principal was, not June 6th, June 1st, 2023. And this $150,000 reflects the outstanding principal as of the date that they originated the loan. Box 4, refund of overpaid interest. So first and foremost, it says in bold print in the instructions, do not deduct this amount. So now we'll walk through what this amount is. This is considered a refund or a tax credit for overpayments of interest that you made in a prior year or prior tax years. So if you previously itemized deductions in the year that you paid this interest, then you may have to include part or all of this amount in the other income line on Schedule 1 because it's considered additional income. So for reference, anytime you claim a credit or a tax deduction on something that you paid, and then you get a refund on that thing that you paid later on, usually in the following tax year, you then have to go back and claim that as income in the year that you receive it. So you don't have to go back and amend tax returns. You don't have to make any adjustment on your prior year return. You would simply determine the amount of this box 4 refund that was attributable to that itemized deduction, and then you would claim that as other income on Schedule 1. In box 5, this is mortgage insurance premiums. A lot of people might be familiar with this as private mortgage insurance, PMI. So if there is an amount that's reported in this box, the form instructions say that it may qualify to be treated as deductible mortgage interest. And you would have to go to the Schedule A instructions in IRS publication 936. However, when you do go to the Schedule A instructions in IRS publication 936, they both say that the deductibility for mortgage insurance premiums has gone away. So don't be fooled by reading this instruction. This instruction was last updated in 2022. The other guidance is more recent. So in this case, and by the way, I'm recording this just as when everyone should be receiving their Form 1098s, either in the mail or online, at the end of January of 2024. So yes, this is the most current version of this tax form as of January 29th, 2024. So, but, be careful if you're trying to claim PMI, mortgage insurance premiums. The updated instructions say that you cannot do that. In box 6, this simply states the points that you paid on the purchase of your principal residence. So specifically, it shows the points that you or the seller paid this year for the purchase of your residence that must be reported to you. However, the Form 1098 instructions also tell the lender which points they need to report and which points they do not have to. So our article kind of breaks this down a little bit more in depth on what would be included in this. Generally, anything that's on your closing statement or in the HUD, what used to be known as the HUD 1. So anything that's reported to you, anything that you actually paid, anything that was secure, anything that's directly attributable to the loan, all of those would be qualifications for points that would be reported to you. So generally, they're fully deductible in the year that they were paid. If there are seller paid points that were part of a purchase, then you would have to deduct that from the basis of your residence for capital gains calculation purposes. In box 7, if this box is checked, then basically you might not see anything in box 8. So box 7 simply states if the address of the property securing the mortgage is the same as the payer or borrower's address, check this box or enter the address or description in box 8. Specifically says you don't have, the lender does not have to do both. I did both for illustrative purposes. So if this box is checked, you might see that box 8 is blank. And if this box is not checked, then one of two things. Either this is a different address from this one, and that different address will be reflected here, or this address is the same and it will be reflected here. But if this box 7 is not checked, there should be something in box 8. And if box 7 is checked, then you might not see anything in box 8, and that's okay. So in box 9, this reflects the number of properties that are actually securing the mortgage. In this case, we put 1, although the form instructions say that if only 1 property secures the loan, this box may be blank. But, if you decided, 4 properties, then obviously there would be 4 properties that are securing the mortgage. Such as, in an apartment building, for example. Box 10 may be used at the lender's discretion to report other information. Sometimes this might include real estate taxes or insurance paid from the escrow accounts that you have with your mortgage company. And this could be useful information for you to put either in your tax return. For example, real estate taxes could be itemized as a deduction on Schedule A. Insurance and real estate taxes could be claimed as deductions on Schedule E, so on and so forth. But the lender doesn't have to do that. And if they do choose to report certain information not on IRS Form 1098, then you would have to go find that elsewhere. Just below that, you'll see a field for account number. You'll see this in most information returns, such as Form 1098 or 1099. And if you have multiple mortgages with the same financial institution, then the institution is required to issue a unique Form 1098 for each mortgage. So if you see this, there might be an account number associated with each of those mortgages, and you may see that account number reflected here. So if there are multiple tax returns that they're sending you from the same institution, and you're the same taxpayer ID and everything, then this is a requirement. Otherwise, this is optional, highly encouraged by the IRS, but not necessary at all. So, but if you do have multiple mortgages, then you should see the proper account number for each mortgage that you have reflected in this field. Finally, in box 11, the mortgage acquisition date. If there's a date in this box, this would be the date that the lender acquired the mortgage during the calendar year. So we put this here even though they were also the originator. So just for illustrative purposes, these most likely would be 2 different dates. So that's all we have for what you would expect to see in Form 1098. Again, we're coming up on the end of January at the time of this reporting or recording. You should see this. If it's not in the mail, you should probably be able to access it through an online statement through your mortgage company's portal or however you make payments and check statements. So definitely, I would definitely encourage you to go check that out. And as I mentioned, we wrote an in-depth article that kind of walks you through a little bit more about where you might report this information on your tax return, depending on your situation. It goes into a little bit more detail about how to read the different parts of this form, and also has some frequently asked questions. So feel free to hop over to our website and check it out. You can go to Teach Me Personal Finance, type in IRS Form 1098 or any other form that you would like to read about, and you should see our article up here. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. If you have any questions, comments, or if there's a topic that you'd like to cover in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.